Hello, all you beautiful people out there, and welcome to today's episode here on Prise Novice. Don't worry about the name, you'll figure it out eventually. Today, we're going to talk about three different types of strategies, I would call them, when investing in the stock market. The stock market is, for most people, the easiest way to increase their wealth. The reason being is it's readily accessible in most places around the world. It doesn't necessarily require a huge capital to start. You can always start by investing monthly over decades before your retirement. And so I think, generally speaking, the stock market is where most of the world's wealth is gained, on an individual level at least. Obviously, the richest people in the world made most of their money through starting companies and having other people work for them. So when investing in the stock market, you have to realize it's a volatile ride. Again, as I said in the last episode, Dave Ramsey often says the stock market is a roller coaster, and only those people who get off the roller coaster get hurt. So staying in the market is, typically speaking, and if you listen to Warren Buffett, for example, one of the 3 or perhaps top 5 richest people in the world, he says the very same thing: invest and stay invested. Simple. Now, the 3 different strategies I'm going to come to in the stock market, they differ a little bit depending on you as a person, you as an investor. The main difference is what tolerance of risk you are comfortable with. The first very common strategy that we see in the stock market is the so-called passive investor. And in my opinion, there's actually 2 different types of passive investments that you can make in the stock market. The first being the one that's become very common and famous and promoted over the last 10 years or so, investing in passive index funds. Funds in general are investments that themselves own stock. The laws might be different, but here in Sweden and in Europe in generally, I believe one of the criteria to become a fund is that you must own at least 25 sub-investments, or 25 stocks if you are a stock mutual fund. The index funds, they are a little bit different because they own a piece of everything. For example, me, I'm from Sweden, so I could buy an index funds that track the OMXS 30. The equivalent in London, for example, would be the FTSE 100, or in America, the S&P 500. These are all indices. And an index fund is, when you see on the news that, Dow Jones or the Nasdaq or the FTSE or the DAX, Germany, is down or up such and such a percent, those are the indices that they talk about. Those are the averages of the companies that belong in this particular market or this exchange. So in America, for example, the big one is the S&P 500, the 500 most traded, not necessarily largest, but I believe it's typically the most traded companies. And the same goes for the OMXS 30, Stockholm, the 30 biggest or most traded Swedish companies, and the FTSE 100, the 100 most traded stocks or companies in London. Now, the beauty of index funds is that they own so many companies, and you can truly invest passively. You can invest a fixed amount of your net take-home pay and spread it out over these 30, 100, 500 companies. The second subcategory of passive investing, I believe, is investing for dividends. And it's super common, and I can totally see the reason why people would. They pay a dividend. A dividend is money that's left over in the quarter or the year of the company. And instead of reinvesting it in the company, they pay it out to shareholders to keep them invested. There are different tax purposes and so on as to why companies choose to pay a dividend. These are the Coca-Colas of the world, the General Electrics, the super big companies. Apple pay a dividend, in fact. Not a very substantial one, but they could increase it over time, considering how much money they earn. The attractiveness of dividend investing is that you actually get a cash flow out of it. If you take some of your salary and put it into stocks and you hope that it grows, well, okay, fine, it grows, but eventually you come to a point in early retirement, it comes a time when you want to reap the reward. You say, hey, now I want to quit my job and I want to retire early and, live the rest of my years in a good way without having to work. Well, the problem then is if you don't own dividend stocks, you are eventually in a situation where you have to start to sell off your assets in order to bring cash in, to pay for your bills, to pay for your house, to pay for your gas, to pay for your food. And so the beauty of dividend investing is that if you invest in a company, especially the earlier you start, you get to take advantage of compound interest. Now, obviously, compound interest works in any asset that appreciates in value based on a percentage. This would be, all the markets, in fact, all the stocks, bonds, they trade in a percentage. So the compound interest takes effect. If you are early in your dividend stock investment career, you have something called a dividend reinvestment plan, a DRIP, meaning it takes care of all of the dividends for you, whether it be monthly, quarterly, yearly dividend, and reinvest it into that particular stock. So you put a certain amount in, and let's say you buy 100 stocks. Well, for each year, this particular company pay a 5% dividend yield, meaning that the second year you have 105 stocks without having you yourself paid anything more to acquire those 5 extra stocks. So in the next year you earn 5% on the 105. So in fact it keeps growing and compounding, and it's the snowball effect, the snowball going down the hill. It grows bigger and bigger, exponentially faster. The second type of stock market investing that we see, and I believe is quite common, is the type where the investor uses ETFs or index funds, and they mix it up with some commodities, gold, short-term bonds, long-term bonds, cash reserve. And what they are trying to achieve is a balance in risk, really. The stock market, as I said before, is very volatile. It goes up and down, and you can mitigate some of the downturns in the stock market by being invested in alternative. As I said, this could be gold, it could be precious metals in general, commodities, oil, some real estate, both like physical assets, like houses, like for example the house you live in, or you can invest in companies that provide basic services such as water and electricity. Stock market going up or down doesn't really matter. People still drink water and they need their electricity, and so these companies tend to be a bit safer. And what these people try to achieve, which is incredibly hard unless you are very good at what you do or you have a set strategy. We've heard of Ray Dalio, for example, of Bridgewater, and I think you can even find it on YouTube, the percentage allocation of the Bridgewater portfolio, and how he manages to earn money even when the stock market crashes. Like in 2008, early 2009, the Bridgewater portfolio went up, I believe, 2 or 3%, which was completely amazing. I mean, nobody thought it was possible. These strategies take more time for you as an investor, both to learn and to master. And so you need to be quite comfortable in what you're doing. You need to pay some attention. The reward is potentially higher because you avoid the downturns in the stock market. The third type of investment that you could make in the stock market in general is what I like to call the active approach. Now, the active approach isn't necessarily active once you are invested, but choosing which investments to invest in is a very active decision. We spoke of Warren Buffett earlier. He believes that each investor, to be truly successful, they should have, I believe he said, like a punch card, where you get 20 investments during your whole entire life or your entire career, and that's it. So you need to think very carefully about what you do when you buy these assets or these equities, and you need to keep a close eye, because eventually, he invested in American Express in the 70s, I believe. He bought some Coca-Cola in the 80s or early 90s. I mean, he paid $1, $2 a stock. And I mean, Coke is up, for him, thousands of percents. The difficulty of being an active investor in that regard, is that you have to really spend a lot of time reading quarterly reports, yearly reports. You have to truly understand the company that you're investing in and to be comfortable. In the end, I believe whichever strategy you think is suited for you, it all comes down to your comfort level. Are you able to sleep well at night knowing that, oh, okay, well, my portfolio tonight or today or this month is down 10 or 15%, but I own some assets that have balanced it out. Maybe own the typical 60-40 portfolio, which is 60% stocks and 40% bonds. So you do take part when the stock goes up, and when the stocks go down, you have the buffer, you have the bonds to protect, 40% of your portfolio. Make a decision, and for all intents and purposes, there's lots and lots of information on the internet you can read up on. There are plenty of YouTube channels, just like this one, where you can learn and you can get the idea for most basic types of investments. And please do remember, don't follow the advice of anybody else. Find your own path. If you are young, if you are below 40, I would say, you can take a lot of risk. You have probably at least 20 years of your working life ahead of you. You can afford to go heavy into stocks. Maybe we see a stock market crash in the coming years, who knows. So if you have 20 years left of your working career, you can afford to take some risk. Typically speaking, the stock market takes a dive of 20% or more every 7, 8, 9 years or thereabouts. We've seen some minor corrections. We've seen some huge crashes like back in 2008, which was 10 years ago. Take some risk, but never invest more money than you can afford to lose. Going back to the previous episode, we spoke of paying yourself first, and over a couple of weeks or months trying to figure out a budget that suits you and the need for your family. Obviously, if you choose to, for example, pay yourself 10% of your net take-home pay, then maybe in the 90% budget you also leave a little wiggle room of a couple of percents here and there for saving up for a vacation and so on, so that you're not really affecting your day-to-day life with investing. If your family and you are used to going on a vacation every year, make sure that is included in the 90% of your day-to-day budget. So this was a quick recap of the 3 different types of, well, 4 technically, the 2 passive ones, which are index funds and dividend investing. The second one, which is investing with some sort of strategy, trying to hedge your bets. You own some commodities and maybe you have an exit strategy. And the third one, the more active approach, owning individual stocks and making sure that they are good assets for the long run. Thank you so much for watching, and remember, 50%, half of whatever money this channel eventually brings in, will go to charity, and you as the viewers get to pick which one. See you guys around.